Good afternoon, everybody. Thank you very much for joining us and being on time. There's a few more coming in, and really appreciate you giving up your lunch time to learn a little bit today about this really important topic called cash flow and getting the survival guide. So it's obviously our first episode of Future of Finance, and we're joined by these three amazing panelists. And if you've got any questions during today, please feel free to just drop them into the box, and we'll get to that towards the end of the session. So as I said, get those questions in. We'll try and get to them. Otherwise, just send us an email. If you want to get in touch with any of the panelists that you hear today, feel free to send us and we can get you the details for both Nick and or Tyler or Sharon. As we said, everybody will get a copy of the Cash Flow Survival Guide as well as a recording of the webinar. So I'd like to give a really warm welcome to our three panelists today. We've got obviously Sharon, Nick, and Tyler in here. So Nick Cooper, CFO from Easy Collect, he brings with him a wealth of experience, 15 years plus, having worked with various different organisations, from large pre-IPOs, etc., in the UK and in Australia. I'm really happy to have Nick with us as well. Welcome, Nick. We're also joined by Tyler Caskey. He's a partner at the Bean Counters. He's a very experienced accounting partner and CFO. For those who don't know, he's actually got a massive following on LinkedIn and always put out good content. So go look him up and follow what he's got to say there as well. But yeah, he's got a demonstrated track record across various different businesses, having been a CFO himself at some of them, and these days being a partner at Bean Counters. So I know that Tyler has a relentless continuous improvement mindset and work ethic, he's really excited to be part of this conversation today. We just had a quick conversation offline in just how important cash flow actually is for businesses. So really good to have you on board. Thanks for being here, Tyler. And then lastly, Sharon New, who's the founder and CEO of ProSpend. For those who don't know, we were formerly called Expense Manager. We've been around now for 10 years, and Sharon founded the business then. We had our very first customer on there, and some of you might know who KFC is, and they're still our customer today. And also earlier this year, last year, I should say, we rebranded to ProSpend from Expense Manager to truly encapsulate that we don't just do expenses anymore, but now have a fully fledged business spend management platform. So thank you for joining us as well, Sharon. Right, so before we go on, I thought I'll just put this kind of slide out there and kind of just get people's opinion on this. The Australian Securities Investment Commission just recently stated that poor cash flow is a reason for 40% of businesses collapse. And that is incredible. If you think about how much, things can go wrong in a business and all the different variations, on the topic from COVID to economic downturn, etc. It's incredible to think that 40% of businesses would collapse on the back of poor cash flow. So obviously a really important stat. So Tyler, I thought I'll check with you. Does that sound right? 40% of businesses failing due to poor cash flow. I'm not sure if that sounds correct, but also if that is correct and it is that high, which clearly they say, what are kind of the warning signs that businesses should be looking out for?
I think the spending control is really important, and just making sure that the business knows where they're spending the money and why they're spending it. Does it have a good ROI? And then the third one for me is always about planning for the lumpy payments, like quarterly super, which is, soon turning to payday, quarterly BAS, year-end tax, those types of things. I've seen a year-end BAS and tax bill take down a mid-sized business with 4 employees because they just didn't plan for it well enough.
Yeah. And isn't it true, man, where a lot of companies, sometimes they do cash flow statements, but that's stating the past, whereas cash flow reporting is all about being proactive, right, and understanding kind of what is it that's coming up and truly understanding where those pinch points might be and planning for it. I can definitely relate with that. Nick, as a CFO, I mean, what are the common problems you see, businesses face that we're not managing cash flows correctly? Like, what are the things that they would typically, unpack as soon as they, is not something that they're focused on?
I mean, we could focus on the downsides of that, Leo, which we don't want to around insolvency and everything else that running out of money can create.
Of course.
if we stick to this, let's say more positive aspect of it, if there are some, if we group into two, I think there's things around, it really hampers the growth. So you've got your growth related problems from just not having cash. You need that cash to start to invest in either new products or new services, new marketing, new sales initiatives. If you don't have that cash, then how are you going to do that? Where are you going to kind of hit? Everyone's got a ever increasing sales target. If that cash is not there, how are you going to hit those? And sometimes then you can have that difficulty in securing financing. So obviously lenders want to be looking at a sort of a healthy cash balance. They want to be able to see that you can actually recover those debts, those outstanding balances. And so it can having a sort of a poor cash management record can at times really kind of hurt your own credit worthiness when you're going out to lenders. So it kind of has a twofold effect. You've got bad cash, so therefore you're missing it. But then also when you try to get, maybe you're trying to source some funding to kind of help alleviate that, it can hurt you on that side as well.
Nick,
Yeah,
I've seen the same thing. Like,
yeah,
like we help businesses get funding or maintain their funding or negotiate, an increase or a decrease or a change of type or moving a director's guarantee away. And I would say 60% of the bank lenders, especially their quality control, the people behind the scenes, they hunt our cash flow forecast and our cash flow history more than they do the P&L and the profit. Like the P&L and the balance sheet, they're more just looking like, are you profitable, right? Do you have exorbitant accounts receivables? They park that, tick, 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 and then they go straight to the cash flow.
Absolutely.
That you're exactly right. Like it's such a big marker for the to get you through.
Yeah, I mean, as we know, you can have the healthiest looking P&L, but then be cash poor, and you actually got it just tells two sides of different stories. So yeah, it's really important. So if the guys can do that, that's great. Then again, if you don't manage your cash flow well, obviously it's going to impact your ability to pay suppliers. You start to get maybe some reputational damage. Does that kind of leak out into the market? Do people not want to start to work with you? It's not a good place to be, and obviously you don't want to be in that. But that's kind of one of the things that can be happening if you're not sort of managing your cash well, and you don't want to be elongating your supply cycle. And just then it's not a great place to be. Yeah, not a great.
Yeah, 100%. So I mean, we obviously know that it's an important thing. We've discussed that. Obviously, a lot of businesses can fail as well as a result of that. So I suppose, Sharon, as a business owner, what are some of these levers that you see people that you can use as a business owner to protect your cash position? Now that we know it's such an important aspect and it gets overlooked so often.
So we are a tech company, but distinctly different in that we've never received funding. So cash flow has been so super important for a bootstrap company. It's all very well to have a good, sum of money from VCs, but if you don't have that money from the VCs, then, cash is absolutely critical for a business like ours. And I guess the three most dreaded words you never want to hear from your finance team, your accountants, are negative cash flow. So as a business owner, I have, from day dot, always wanted to keep a very tight grip on our cash flow. It's been super important. And there's two key levers that I use in our business, and that is budgets and purchase orders. Budgets, let's talk about that first. A budget is the financial roadmap that helps make business make operational decisions, and super important for managing cash flow really well. But here's the thing about budgets: they're only as good as if we stick to them, right? And one of the problems that companies have is actually staying on budget. And making sure that the people that are spending the money actually know what that budget number is.
So being proactive, right, Sharon? So I suppose the problem I've seen with budgets in the past, it's great, you've got a budget, and then a month later, on the 16th of the month, people go, how do we go? But proactively knowing where you are with your budget is crucial. So being on top of that.
Yeah. and it's got to be visible. Often budgets are, on a spreadsheet, on somebody's desk, somebody's computer, and nobody knows what that budget number is. So I think if you have to have budgets, but if you're going to have budgets and you want to stick to them, they've actually got to be very visible to the people that are actually spending the money, right? And and I think the easiest way to make that budget number sticky with people is, first of all, make it visible, and that's possible now with budget tracking software. But the other thing that I think is very important that businesses should think about is, what about purchase orders? I know that's like an old-fashioned thing, right? Asking for permission to spend money before the spend. And I know in the past it's been hard for businesses to get purchase orders, into their company, because in the bad old days, purchase orders were, a paper book, and it was written out in triplicate, and somebody had to go and ask for it, and then that piece of paper would float around the organization. And, so it's not easy to really get purchase order culture into a company. But again, that's different today. Purchase orders are now very much part of that digital way of spending money. Purchase orders now can be on a mobile. People can actually create a purchase order on their mobile, and
while seeing the budget, right? Being proactively seeing the budget while raising the PO and go for electronic approval, right?
Exactly. So, it's super easy now for businesses to be putting in not only budgets, but visible budgets, but also being able to put in purchase orders that are not onerous to do. They're super quick for users, super quick for approvers, because approvers can, approve purchase orders on a mobile. And they just don't get you won't get the pushback anymore from people if you try and enforce purchase orders. And look, really, they are the gold standard for cash flow management, purchase orders.
Yeah, those are really good levers. Thank you
for that is if you've got purchase orders and budgets in the same application. That to me is one of the two really good levers that businesses can pull to manage their cash.
Yeah, and those purchase orders are so important. So go for it, Tyler.
Yeah, Sharon, thanks, Leo. I was just going to say, there's something you said there that I don't think I ever did as a CFO in my time. Was I was never as visible as I should have been with the budgets. And I think when the budget changed, like if we were under or over, I wasn't maybe visible enough with the why it's changed. So why am I cutting 30% off your marketing budget or your recruitment budget? And I think that's probably the lesson I had with hindsight of like 20 years in finance was, more transparency around that, and that honestly, that could just be an email to the leadership team sometimes as well. But
and I think people genuinely want to stay within budget. I think, people are really quite responsible, but if they don't know what that budget is, they're blind. They're running blind, aren't they?
And you're exactly right there. Like that's where, like, I do a bit of quite a lot of retail work. And like the retail systems and manufacturing systems always had purchase orders in them the whole time, right? Yes. And now what I'm kind of finding is the market, that technology that was built into those things, because you can't go buy 5,000, chicken breasts for a restaurant without it going through the boss. Now that technology is available to most people in the business world with easy technology. And I keep thinking about my times when I was a law firm financial controller, trying to tell off a lawyer who spent $700 a night on a hotel because that was the closest one to the office after he had already spent it. It's such a hard conversation to do after, but to do it before, I'm like, absolutely not. Yeah. And that's the change in the market I'm seeing is really the technology is now available to everyone rather than just these high-end, high-product businesses.
Yeah, I can relate to that. And I think, Tyler, a lot of our customers that come in, and sometimes even our existing customers would say to us, do I need to now, upgrade to a whole new ERP solution to be able to just do POs? Because some of the accounting systems don't always have it. But these days, there's so many options for people, and those things can all integrate. So it's obviously one of the things we do, which is so crucial, because by the time the invoicing comes in as well, you've already got the PO that was approved, so you don't have to go and approve the invoice again. So that can then flow through the system, right? So you actually speeding up accounts payables work at the end of the day as well.
Yeah.
Which kind of leads me to the next question, Sharon. I wanted to ask you just around how automation can help managing cash flow.
Yeah. So, I mean, I think people will. Oh, sorry. I think my battery's just about to die on me. Wait a minute. So sorry. Oh God,
That's okay.
Technology, Sharon. Technology.
There we go. We're good. We're good. Look, there's lots of processes that can be automated today. There's lots of cool tech out there now. You know, and we'll talk a bit about, you know, the benefits of easy click with automation on AR. And, you know, I'm going to talk a little bit more about, you know, AP automation and how that can really improve your cash flow. But I think if there's one process that companies should definitely look at doing first before anything else, is automating that credit card reconciliation process. And you just alluded to that, Tyler. You know, people are going out spending money on these cards, and often that credit card spend is really hidden if it's done, you know, if the reconciliation is done in a manual process, because they'll go and spend the money. And then, you know, for them to actually put that reimbursement claim in, that reconciliation claim, can sometimes take weeks and sometimes takes months. But of course, what happens is the business still has to pay that credit card on the due date, because otherwise they're going to be paying high interest rates. So businesses are often just paying all of this spend without even knowing what that spend was for. So if you can automate that process, which is so easy to do today with automation tools, you're really ahead of the game with, you know, those hidden expenses. You know, and it's not just the fact that not only are you going to improve your cash flow because you know what they're spending and you can quickly monitor it and get ahead of it. You know, if they overspend 1 month, if you know that within days of that overspending, you can correct it. So that's one area you can really improve your cash flow. But also, you know, disputed expenses, they can just, you know, lie in the system for months, and, you know, they're never followed up, never recovered often. And even personal expenses, people do spend, you know, unfortunately, you know,
catching
on
the exceptions, managed, you know, by exception, and not 100%.
Trying to claim that back years after, you know, or months after, and nobody remembers what that spend was for. So if you can, you know, get that process happening so quick, and you can do that now with, you know, credit card data feeds can come in instantly. You can be tracking it instantly. You can be seeing it instantly, and you can also be seeing that spend against the budget. You know, that means that you are really tightening out that cash flow. But the other real great advantage of automating that credit card reconciliation process is not just the fact that, you know, you're improving your cash flow, but you're making your employees happy. You know, literally nobody wants to fill out a paper form anymore.
Especially in the current economic climate, you're right, with the cost of living going up.
I mean, if you said to somebody, you know, the millennials today, you know, fill out a paper form to justify, you know, your spend, they're going to go, hang on, there's got to be an app for that, surely, right? So it's, you know, if you can automate it, then not only are you tightening your cash flow, but you're just making your people a lot happier. It's a win-win by doing that.
You're also saving time, right? I suppose as the CFO or the financial controller, you spend less time doing manual things and you're letting the systems automate it. So, which makes absolute sense.
The cost to process a manual expense claim is very high. You know, you times that by a company that's got, say, 100 people running around with credit cards, and the processing time, the approval time, and the rekeying time for somebody to do that in accounts payable, you know, it's very costly. Yeah.
Some of our customers, just to shout that out, they've actually said that they've saved, in their opinion, 85% of their month-end closure purely because they don't have to go and chase all these things manually, and because of that feed coming in, automated, pre-approved, everything kind of working. So, which kind of, Nick, if I could maybe move on to you. I mean, sure. You know, digitization, you know, was a big word a while ago. Everybody was like, you know, we got to be a digital transformation, you know, but how do you do that for cash flow, and how can that help cash flow?
Well, it's good. It's a good question, Leo. And then I guess maybe a rhetorical question here for you, but, you know, I'll approach this from sort of maybe the AR point of view, is why do many businesses today still chase payments the way that we did it when computers were first first came out, we still are on the phone. We're still, like following up just manually. We have teams of people sort of chasing these things. The technology advancements and the digitization, as you were saying, that's happened since then, that the AR hasn't really kind of caught up with that. And can cash flow, that's very much just one side of the cash flow sort of equation, but, you still have a lot of people just doing it manually. So, there's two parts, I think, to the way that the digitization can sort of help out. Firstly is the onboarding of clients. So, there's nothing better than knowing that you're going to be working with a good and a safe client. So by that I mean is, historically people would, want to understand who they're working with. That's fair enough. But they might ask them on a paper-based form to, submit some details. They might go and check that. They might get some trade references. I'll call them up. They'll say, oh yeah, they're a good bloke to work with, or they're a good company. Yeah, they pay their bills on time.
It's my cousin. He'll pay you.
Yeah, exactly. Meanwhile, you're not, who are you talking with? You're never quite sure. And so, yeah, that process of onboarding that customer takes a while. But if you can implement a sort of an onboarding automated flow, then, you can speed that up and you can get those new sales coming through the door much faster. So obviously helping your cash flow in that sense, getting new sales in quicker and in an improved fashion. And then the digitization of the whole, I guess, collection process from the actual sending out of invoices, the following up of those invoices, and then collection of payment has improved dramatically. And look, I mean, everyone remembers the COVID just exploded digital payments, especially in the B2B world. Obviously, is where we're sort of focused. Obviously, digital payments have been around for a long time in consumer-based fashion, but B2B, people still used a lot of like bank transfer and sort of, had been sort of quite old school prior to COVID, but yeah, COVID sort of changed a lot of things. And, digital payments, it can really help increase the transaction speed. So if you are putting on payment links on your invoices, if you're basically removing those barriers to people paying on time, then, it's going to improve your cash flow and you're going to get paid a lot faster. So,
we're not running polls, but I would have loved to actually ask everybody online, of which there's quite a few, how many of those actually have a link on their AR invoices to allow customers to pay that way. And I doubt that would be, above 10%. But yeah, it's such a crucial thing to remove that friction, right?
Oh, absolutely. I mean, literally just the other day, AJ, one of our co-founders, he handed me an invoice from one of our partners, our ERP partners, a big one. I won't say who, we won't name and shame, but they sent across an invoice, and yeah, there's no payment link. It was quite old school in the way it was sort of configured. and so, my inclination is to, okay, well, I'll put it in the inbox. I'll send it off to the accounts team. I'll get, where if there's an opportunity to real time pay that, then a lot of the time I will. And so, yeah, I think the advancements that have happened in that space really can, help reduce like that days sales outstanding is a key metric that we try and track and follow. And that's the one that we're trying to improve for customers. And yeah, smoothing those ways of collecting payments is a really big way for that to happen.
Making it easier for the customer to pay, and like you said earlier as well, like, being able to help with potential digital credit applications where you could truly test through digitization and with all the data and AI that's available these days to truly understand who you're doing business with, so you kind of have a better probability of them paying, but then making it easy for them to pay as well.
That's right. Absolutely.
Yeah. Tyler, can you give me an example of how a business, I mean, you work with so many different businesses, and you mentioned in retail a little bit earlier, and I know you work with quite a few in various different industries, but where maybe one business has improved through the adoption of digital or automation software around their cash flow.
Yeah, I've got a few, and I'll try to do it succinctly. And Nick, I cannot express or reiterate how important the words you said there are about automating data collection follow-ups and just throwing on a payment link. It's such a no-brainer now. And there's levels to it at the moment. Like everyone knows Xero, you can drop in Stripe or Go Cardless pretty easy into Xero. you can also, there's like 5 auto reminders. But, I like that as the entry level. I really like businesses like Easy Collect, and there's obviously a few competitors in the market, but like
they're not as good though, Tyler. You could say that at the outset. But yeah, there are some. Yeah.
But like, my example of that is like I came into an accounting firm as a partner, and I just looked at the debtors, and there was like $3 million in debtors. And we got it down to, instead of being consistently at 3, we got it down to $1.5 million.
Wow.
Within 9 months.
Wow.
Literally, same size business, right? Literally by just adding automatic reminders and putting on a payment link, and then, like doing some follow-up. So we did add like an app, and we, because sometimes 5 follow-ups aren't enough. So I'm a huge proponent of that. Like, I just think, I always think in my head, leave no reason for the customer to not be able to pay you. Like,
Make it easy.
have a phone number, have an email address, do the simple things that when you're following up that make it easy. Have good invoice numbers, send it to the right email address. The basics are what get you paid. But that's kind of on the revenue inside. On the money outside, like I've got, I was a CFO at a design business, and this is before beautiful products like ProSpend and Airwallex and Wheel all came into existence. And I put in zero expenses, and I installed a whole myriad of new processes and job tracking systems. And more than anything else, people came up to me like, "Thank you, Lord, for not, making me scan receipts and put them on a piece of paper." And so like now I'm seeing in the market, like we helped a client choose ProSpend recently, and there were 2 big things they had that they were struggling with. Number one was, like automatic collection of data once someone spent money. And that's where like the debit cards for ProSpend were just like, it was a no-brainer. But the second one that I absolutely loved is, Sharon, I know your team must have taken a bit of time to develop this, but for a large group, you were able to track duplicate invoices across multiple Xero files. Right. And I remember like I researched 6 different payment platforms, approval systems, and so many platforms are just one for one. And then I remember I found it to the CFO, and she was like, why isn't this like the norm? And because it's such a big risk, because the risk for, Nick, I guarantee Easy Collect's got more than one company, and the amount of times people will load the same invoice on multiple invoices and pay it. Duplicate payment invoice is such a risk. And for a CFO, it just makes you nervous that you're going to make a mistake.
Absolutely.
Yeah, huh?
Yeah. I said earlier, that's the best thing I like about Yeah, it tells me you paid this before. It can happen so easily. Yeah.
That fraud detection is so important on the AP side. I just want to talk about that, Tyler, for a second, because I think one of the key things that a lot of our customers that come on, truly are looking for is the ability to know, like you said, whether this has been paid before, but also whether there's a spike in spend, to see whether this thing has been intercepted in between, because these days there's so much fraud going on. You just need, as a CFO, one of the things you always want to do is de-risk everything, right? And so the payment is probably the most crucial side. So I'm paying suppliers. Is it number one? Is it the correct supplier? Did the bank details even change? Can a system tell me whether I paid this before? Is it a duplicate? Does the bank details match what it should be? There's a lot of things that systems can do these days to try and amplify that fraud part on the AP side.
And I think about audit trails. So I remember when I started in like 2001 in KPMG, there's no audit trail anywhere. It was just who did this, and you had to look at the file to see the initials, and it was NIC, and I was like, oh, it's Nick, right? I was like, okay, Nick, why did this journal go in? Now with the beauty of like, I know ProSpend does it, Xero does it really well at the bottom, NetSuite does it pretty well, Microsoft Dynamics does it terribly in my opinion, but like having, Sharon approved this invoice at this date. If I'm a CFO, I just don't have to like waste time or cry trying to figure it out. And then Sharon, to your point there before about speed of the finance team, they know who spent the amount, they know who's missing the receipt. So you don't have to like try to figure it out, like who spent it and why. What it does is it turned me from a CFO that was chasing to a CFO that had information and could delegate that task. So instead of paying me $5 million a year, if I was lucky enough, I could delegate that to the right person. And that's where the automation takes finance teams and turns them into a value creator rather than a churn factory.
Yeah, we had this conversation the other day, and there was this incredible thing where we're sitting at a round table, and the lady is the CFO for a big union, which I won't be naming as well, but she was just saying how she would love to be a bit more proactive. She's just seen us all running the reports reactively for people, as opposed to, like you said, taking that value, putting these things in so that she can contribute, because there's so much more they can do in the financial teams normally. So yeah, really good point.
But it also lets you, and this is where I think Tyler's going, you can empower the rest of your team. So, I don't want to be that person who's sitting on top saying, I have to centralize kind of approvals because I don't have the ability to kind of say, all right, I can see who's, John is looking after this account, he's signing off that, and he's done it. But so I have to pull all that internally. It just empowers everyone to be responsible for their own spending, sticking to budgets, as Sharon was saying earlier. The business just operates much more efficiently because of that. And there's a lot more trust within the business. Like I say, it's finance is obviously a lot of the time seen as wanting to bring things into the middle and centralize and hoard the money. We don't want to. We just when the processes are poor and when the systems don't support a distributed ability to have visibility and approvals, then then it has to be brought into a central process so you can control it. But if you can send that out and distribute that, then it's the business can operate in a much better way.
Yeah, so Nick, I suppose from an accounts receivable point of view, I know, obviously there's a lot of that written in the cash flow survival guide, which everybody will get a copy of. But just from your perspective, like around accounts receivable, like what are some of the ways companies can go about to protect that cash flow?
So I guess I normally see this as, 4 key things that people can do. And it's very much happens across the whole life cycle of the collection process. It's not, if you're trying to do everything at the end, then it's already too late. So it starts, and we've spoken a little bit about this earlier, it starts up front. So if you secure your cash flow at the outset by having like a really robust client onboarding process through that automation, like we were talking about before, you want to work with clients that who they are, that they're going to be a good partner, and that they're going to pay you on time. And so if you have that process which incorporates those credit checks, like we're saying, new customers, you can help determine the credit limits you want to have with them. You can predetermine the payment terms up front and then get them onboarded quickly. Well, then that's great, right? So you're in a way hedging that these are going to be a really great customer and that we're going to get paid on time. You layer into that onboarding then the collection of payment authority. So it's a new thing that we're sort of putting out there, which is in those onboarding forms is a credit application and a DD, a direct debit authority. So capturing upfront that, hey, if you want to work with us, this is how we operate. In your terms of service, you can put that in, but we will take collection from your credit card, your bank, whichever you choose, on the invoice due date, and that's just how we operate. So if you can do that, you're really securing that you're going to get paid up front. One of our catch cries is 0 days late. So, if you can, you're really sort of saying at the outset, like we're going to get paid on time here. So that's at the very start of the process. Then the second part, and this goes to what Tyler was talking about, is having this is one of AJ's, our co-founder's special terms, human automation to AR collection. So, Tyler was talking about, Xero's got some 5-step process to follow up and collect payments, but that is automation, but it's not. People see through the kind of the sort of the generic like templates that kind of go out after a certain amount of time, and they choose to they're going to go, oh look, that's the 4th warning, I got another one, that's all right, I'll wait further, and they know that they can understand, they can see through the generic sort of mass templated approach once they're used to it. And so if you utilize a system sort of like EasyCollect, but there are others, as we said, out there, where actually each automated workflow has this human element to it, and introduces sort of different channels. So it can be via SMS, it can be via email. Like we said, there can be a sort of a human phone step within that. Then that sort of automation and I guess like improvement to the workflow can really make sure that you collect what is due as soon as humanly possible. Then the third one I would say is like really monitoring your clients, because a lot of the time, let's say you've onboarded great clients, that's awesome. You've used what I suggested in step one, but actually times change, industries have hard periods. You really got to start to continue to monitor and understand your clients and get insights around their payment behavior. So if you've got a service which can sort of monitor their credit scores, if you've got a service which can understand their payment terms. Now, some of this you can only we work with 1,200 plus businesses. We have sort of 300,000-400,000 people paying into those businesses, so we can see like quite a large number of receivables that go through the Australian market, and we can see who is paying who on time, or who's paying other people later than you. So, for example, if I am getting paid by someone 90 days, but they're paying other people in 30, is there a relationship issue there? Is there something that we need to go and sort out? So if you can start to get insights into your portfolio of customers, you can again really secure I guess your cash flow by
and like
really drilling in,
right?
Yeah,
absolutely. And then obviously correlating, like you said, certain things to see whether there's a trend for whatever reason on the back of the fact you got all the data, and we've got obviously a company like EasyCollect with thousands of customers you've obviously got a bit of an idea as to as a cohort kind of what the trend is at the moment, and to kind of benchmark you as a business against that to see what you need to adjust as well.
Yeah, exactly. And then I guess the fourth and final step then is the one we've already talked about, which is not having the barriers to pay. So offering payment methods that work for your customers. We talked about nothing stops people paying more than just actually not providing a way, or not providing an easy way to do it. So pay now buttons on digital invoices, linking up to gateways, having payment portals where people can review outstanding invoices in totality. A lot of the times people will interact like multiple times and have multiple invoices outstanding or due, and actually they can select and pay each one in turn or all together. And having the ability to have like payment plans. Sometimes businesses do have their own cash flow issues, and this is exactly what we're talking about. And so being able to support them, they might be a really loyal and long-standing customer, and just because they can't they're having a tough time paying right now, if you can support them with like a payment plan option, then that's really valuable, and that will pay back hopefully in the long run. So having that a lot of those methods is really helpful.
Yeah, and also being able to do that digitally. I think these days, in the past it was we had payment plan, pay me whenever, but then somebody's got to remember to do something. Whereas within the system, you could obviously put those, parameters in, and then the system can drive everything else for you. So no, really insightful. Thanks for sharing that, Nick. And obviously, I know a lot of these things are also possible within your solution. So Sharon, just from your perspective, a similar question though, but more around the accounts payable point of view. Seeing you look after the AP side, just what are the ways businesses can protect themselves, their cash flow around, specifically as it relates to AP?
Yep. So when a company automates their AP, they are absolutely ahead of the curve with more cash in the bank in two ways. Just automating the cost, just automating manual processing invoices delivers a better bottom line. I mean, there's heaps of stats out there as to what it costs to process an invoice manually, from $15 to $40 per invoice. It's quite scary. So let's just say take an average, $27.50 per invoice to process that manually, versus $3 if you're automating it. That if you are doing 500 invoices a month, guys out there, instead of spending $165,000 to actually process those invoices.
Just to process it.
Just to process it. You can get that down to 18,000. That is significant cash flow management just in that one, factor of being able to automate it. But it's not just, that automation gain and therefore better bottom line. Things like incorrect keying of data that happens in the AP teams. They key in the wrong amount because it's manually done. And it happens. You can imagine these poor AP clients, keying in. Yeah, exactly. Keying it.
Add an extra zero to Tyler's invoice.
Yeah, they've added another zero onto that bloody invoice and it just got paid. Instead of it being a $2,000, it was a $20,000 invoice. That's such a common occurrence. And of course, as we said, paying suppliers twice, it's such a common problem. And of course, probably the biggest issue that companies have is paying fraudulent invoices. The ACCC advised in 2022, payment redirection scams cost Australian businesses $224 million. And, that has just been rising exponentially since COVID, right? It just boomed. Yep. So if you don't have, really good controls over those invoices coming into your platform and really knowing who you're paying, then you are just wide open to have those, paying fraudulent invoices. And if you're doing, thousands of invoices a month, it's so easy for that to happen. Automated solutions, you get the invoice, it gets sucked in, it's OCR scanned, and the tools now can look at the bank account details that are on that invoice and match that against the supplier records, and it'll say, hey, this is not the right bank account you're paying into, and it'll hold it up, right? And so it instantly stops that those fraudulent invoices coming in. Internal fraud, unfortunately, too, that's also on the rise. Internal payment of fraudulent invoices from an employee within an organization. So again, automation can lock down, the supplier, records. Supplier records cannot be changed by anybody, so that those suppliers that, records, if they've been changed, you can stop that, quite easily as well. Even thing like variance flags you can put in now. A supplier sends you, an invoice every month for, $1,000. All of a sudden, an invoice turns up from that same supplier for $10,000
with the extra zero. The one with the extra zero.
There needs to be a heads up, and you can put a heads up in there to your approver. They might not be intimately aware of that supplier, but all of a sudden they can see, hang on, that supplier's invoicing you $10,000 this month instead of $1,000. Something's wrong here. So, there are all of those really great steps you can put in the process. But I'm just going to go back to the old POs, right? Because that's such a subject dear to my heart. You take that to the next level and add in validation against the PO, remember? That gold standard. If you've got a PO that was raised for 1,000 and that invoice came in for 3,000, all of a sudden that's a red flag as well, right? Not only is it that the supplier might be overcharging you, but somebody is overspent, right? And
there's the traditional thing there, Sharon, which I like to highlight on that, because that matching of POs invoices is crucial. A lot of businesses have always thought it's only the ones that's got stock, or like I know Tyler spoke about the retail, where in that industry that's kind of what they have to do, but nothing prohibits businesses from raising service-based POs and then tracking that on invoices as well.
Absolutely, yeah, that's right. So look, AP automation is really just such a way that businesses really should be doing their paying of their invoices these days.
Yeah. Just conscious of the time. So Tyler, I just want to quickly jump to you just to kind of get your thoughts a little bit around adopting automation and how that would improve employee performance. But at the same time, kind of what skills are required these days in finance teams to kind of adopt that digitization and automation?
Yeah, it's a key part, I think, now of any finance team is knowing when to change. We in finance teams, we spend a lot of time making sure we keep up to date with tax, accounting standards, getting our month-end reporting. what I always did for probably the last 12 years when I was in industry as like the financial controller or CFO, is I'd make sure my team were constantly going to webinars or going to training sessions about new technology. So they knew what the market was. They knew if, Easy Collect was good. I also want them to know what it connects to, about how much it costs, and what are the pros and cons of that, and be able to express that in a team. So I'd always get about once a month people to kind of listen and learn to that. The second part then, especially in like Nick's and my role, is you have to learn how to sell the technology. You actually have to learn how to walk into a board meeting and say, I want to do this, and it's only going to benefit finance, or I'm going to do this, it's going to benefit finance, plus it's got a huge, broad, ranging approach. And then the last one there to me is about how to choose technology that fits your business and install it at the right period of time. So a lot of people always say to me, I want to do my payroll transition 1 January or 1 July. I've always found that there's a time to crash and bash, and then there's a time to do it slow and steady. And if something's broken, I often just behind the scenes crash and bash something in, because anything's better than a broken system. The other option then is, like, if everything's going pretty well, slow down, write a project plan, organize the team, create your budget, create your timeframes, work with your vendor, and then slowly install it. So knowing, especially when you come into a business, knowing to take option A or option B, red pill, blue pill, is a pretty key skill I'm seeing.
Yeah, that is such a critical thing. I mean, there's two things you mentioned there. One, how do you pitch to the board, and how do you make sure that they don't just think you're going to save time, and then what are you going to be doing with your time, right? So being able to truly explain the ROI in real terms to all the other different stakeholders become a skill that's required for people adopting, some of these tools. So I really like you talking about that. But there is this concept where people think everything's got to happen at year end. For whatever reason, it's like a new financial year. But a lot of the systems these days, and even on the ERP side, it just has to be at a month, and a lot of things can be backdated and put back into the GL, and you can still get all your reporting out. You don't have to have all this crunch time, when the auditors are there as well. So I really like you highlighting that. So I just kind of want to draw it to a close, and maybe Tyler, will go from you to Nick to Sharon, just to some final thoughts. I mean, we spoke about a number of issues today, strategies, and we'll give everybody a copy of the cash flow survival guide as well. But kind of just in summary, your final thoughts, Tyler. Just we've spoken about a lot of the benefits, but like just maybe summarizing those key things you think your businesses will gain from focusing on their cash flow.
Yeah, for me, I think the key thing is about anyone in finance should be focusing as much on their cash flow as they should on the profit and loss and the balance sheet. And the second part for me is trying to choose the right technology to suit your business that enables your finance team to be valued and to actually enjoy their day, and then to use it to minimize fraud prevention. And then my last one is, dear Lord, do a cash flow forecast. If you're not doing, I've got a template. Anyone can reach out to me on LinkedIn. I've been developing it at AGL since 2015. I'll send it to you for free. It's my painting of the Sistine Chapel. Just, dear Lord, do a cash flow. It can be weekly, it can be monthly, but just do it. It will save you so much time and risk.
Love that. Thank you, Tyler. Nick, final thoughts?
I think, and look, not to jump on the AI bandwagon, but I think watch this space for how AI, both within all the tools and technologies we've been talking about today, will, I guess, help accelerate and improve the cash flow management and the cash flow cycle within this process. So just the usability of tools and just even further automation of those activities is going to be really interesting. So it's not going to be here tomorrow, but it will take time. But I think just seeing some of the applications, we're tinkering with bits and pieces, and we've got a really easy, really low level one right now implemented into our product around an AI generated single on demand email, whereby you can pick the tone of voice, you can is it going to be mad, angry, or nice tone, and it just sort of writes that for you. But in the future, that'll be able to automate, like, show, you'll be able to ask it, show me all my high risk customers, and send a demand letter to each and every one of them. Is going to change the way that this kind of cash flow process happens. So it's going to be really interesting. So watch the space.
Fantastic. Thank you for that, Nick. And Sharon, just final thoughts from you.
Yeah, so I read a great statement recently from a business executive, Jack Welch, and this statement really resonated with me. And he said, and I quote, "The three most important things as a business you need to measure is customer satisfaction, employee satisfaction, and cash flow. If you're growing customer satisfaction, your market share will grow. Employee satisfaction gets you productivity, quality, pride, and creativity. And cash flow is the pulse, the key vital sign of a company." So I see cash flow as being a reflection of the other two pillars of a business.
That is brilliant. I really love that. That truly is something that should be put up on every business as you walk through the door.
Exactly. I'll be on board with that, I'm sure.
Yeah, for sure.
So I thought I'll put that up on the screen anyway, whilst we give everybody just some time for quick Q&A. We've probably got about 7 minutes left. So if anybody's got any questions, please feel free to reach out to, we've got Nick and Tyler here, with all their experience. If there's any key questions you want to direct to them, please feel free to pop those through. And I've obviously put that Jack Welch quote on there as well that Sharon just quoted then. Feel free to pop anything in. I can see there's quite a few questions coming through already, so thank you very much for that. I suppose this one's probably more related to you, Tyler. I'll probably shoot off the hip here. The one kind of just asks us here about how much does automation help with month-end closing specifically and reporting? What automation, I suppose, is there around those things? Because I know there's the black lines of the world, but these are all top-end tier stuff. What can a business in the mid-market do around these things?
Yeah, man, this is my favorite topic. I do like talking, automating payments and collecting debts, but closing month end, like I've closed $55 million or 400 people businesses on day one, and my best ever was midday on day one.
What a dream!
Yeah, it's
wow.
And I've followed a guy named Stephen Bragg called The Fast Close. He's got a podcast. It's incredibly dry, but it's fantastic. But for me, the magic here is about speed of payments. Like I've always found there's two things that slow down month end. One is billing and matching against your billing, and then two is matching against the prior payments. And Sharon, I promise this isn't just me trying to pump up ProSpend, but businesses like ProSpend or some of the smaller ones in the market like Wheel or Airwallex for the small people, it's a no-brainer. Like it's a no-brainer now. Like my team uses all the automated payment platforms to not be waiting 10 days until Timmy gets back from his holiday to collect the receipt for his last hotel is absolutely fantastic.
Yeah,
so
instant daily transactions. You need them. It has to be in
real-time reporting.
Yeah. And I know some people still hold dearly onto their points balances, but I value my time more than I do my points. And like I only travel with automated cards now because it's just like my time per hour and also my time, when I'm traveling. I don't want to be spending my time like coding things, at night doing a batch. Yeah. So to get that monthly reporting, you just need to make it simple, make it easy, and then close as hard as you can. Make it like really good estimations. You only have to be perfect once a year. Each month end, you need to be between 90 and 95% perfect. Don't worry about getting a $40 accrual for a taxi. It doesn't matter. That can just hit next month. That's it. Yeah.
No, I love that. Just running on to the next question here. Sharon, I know you spoke earlier, and probably that's where the question comes from. You spoke a little bit earlier about, proactively, measuring budgets and things. The question is, can I control my employee spending limits on expenses? Because it's great to give them a card to go and spend, but how can I control that they don't then spend anyway things that they shouldn't spend?
Yeah. Well, the latest thing, of course, now is virtual cards, and we just love virtual cards. Credit cards, some companies obviously are still using credit cards, but you know, and you can get the data in really quickly now, and you can be monitoring it. But if you're using virtual cards, one of the best things about virtual cards is you can actually put in limits against the spend. So it can be daily limits if you want to be really onerous. It can be monthly limits. And it can even be limits to specific, you know, suppliers. So, you know, you're only allowed to spend $50 a day on a taxi. That's it, right? You've got all of those controls now with the use of virtual cards, which could be spun up instantly. They can be closed instantly. They can be frozen as well. So they are one of the best things that have come about in the marketplace in most recent times, is the use
Amen.
of
Amen.
cards.
I don't use physical anymore, ever.
No, that's right. You know, although interestingly though, Tyler, you know, we do have the option now to give some of our customers physical cards, and there is sometimes still use cases for that in the NFT space.
Hotels, they kill me.
Hotels,
Yeah.
but they are just an
Still got that
extension of
old
the
machine
virtual
where you got
card, right? It's still got the controls of the virtual card platform. So, and the best part about, you know, virtual cards is, you know, companies can see in a portal exactly in real time those transactions coming in, and it you know, automatic claim creation and you know, monitoring that spend and controlling that spend.
And
so
once again, controlling that proactively and not waiting for the month-end statement that takes the next month to only come through the door. So yeah, really love that.
It's right there. It's right there. You know, the month end for the next month, it's there. You're done and dusted, because not only are the transactions coming in, but you're creating the expense claims automatically. So people don't even have to create an expense claim anymore. It's done for them.
Yeah. No, that's really good. We got probably time for one more question before we wrap up. Nick, I'll probably just give this to you around credit terms. So, you know, what would you recommend are appropriate credit terms? I know it's a bit of a weird term, because maybe that question depends on the industry they're in as well. But, you know, what is it that you would say it would be your recommendation around things like credit terms and credit applications?
I think, I mean, it's a good question. And it does depend on each customer. If you can take an approach whereby, you know, you evaluate each client in turn. Now, some of this sort of goes back to what we were talking about in the session around understanding that client's, you know, creditworthiness, understanding, you know, like how they interact. Again, sometimes, you know, there's no point implementing, you know, 30-day net when that doesn't work for you or for them. So I would recommend an approach. Now, that is challenging, having different terms as well for each individual client. So you want to have some level of a systematic approach for your business. Not everyone can be bespoke, but I think being flexible to being able to work with bigger customers is important, but also then being flexible to you know, take a risk on some of those other ones, is because sometimes some people won't have any credit scores, and so, you know, there may be a new business or a new supplier, and so, you know, normally you would maybe take it take a sort of a really let's say cautionary approach, but that might not work for them, so you need to bring it to push it out. You need to, you know, be flexible, basically, is what I would say. Yeah,
and systemizing it. Love that. All right, so look, I think that brings us to the end. I'd love to just thank everybody that's joined us. First and foremost, our panelists, Tyler and Nick, thank you very much for your time today. There was some invaluable insights you guys shared today, and some quotes I think I'll try and strip out and share as well. They were just fantastic, you know, just gold dust that a lot of companies are missing. And as you said, just focusing on, you know, P&Ls and balance sheets when, you know, cash flow is so important. So really appreciate your time today, and for everybody online as well. If any of you have any questions, please feel free to, like I said, send that to the email on screen, and then we'll get back to you. If you need to get in touch with Tyler or Nick, we'll get the information. We'll share that with you, and we'll also send everybody a copy afterwards. So without that, our next episode will be coming out in a month's time, episode 2. Please tune in for that. But thank you very much for your time, and we'll catch you next time. See ya.
Thanks
Thanks much, everybody, for joining.
Thanks, everybody.